ASML is down almost 10% in the last month and continues to drop day after day, week after week. It is an incredible company. It is one that I will be adding to my portfolio as I explain my strategy over this episode. We're going to take a look at the company, understand what is going on. We're going to see at what price is this a buy now. We're going to look at the historical performance of ASML Holding. We're going to jump into their income statements, look at their top line revenue growth year on year, as well as that all important bottom line net income. We are then going to jump into the balance sheet, taking a look at a very quick health of the company, the cash versus their total debt. And this in turn will lead us into that all important dividend safety of the company, as well as some very important financial metrics you need to understand before investing in this company. And as always, we will run it through our stock valuation model, getting to our intrinsic value of the company and therefore our acceptable buy price given our margin of safety. Now, it is towards the mid-range of the 52-week low and high. As I mentioned, it is down nearly 10% over the last month. And as we can see, it does offer a yield of around 1%. Now, we want to understand, is this severely undervalued or is this going to continue to come down? And at what point should we pull the trigger and buy this company? For shareholders who have been holding the company over the last 10 years would have seen incredible growth around 512%, which is very, very strong for an investment over the last 10 years, not including that dividend yield or reinvested, of which your yield on cost could be in the double digits. And that's what we're looking for today. Can we see over the next 10 years incredible growth as we've seen in the previous 10 years with that yield over time going into the double digits? Now, in terms of the company and the revenues, typically we like to see 3 to 7% growth year on year. In December 2018, we saw top line of 12.5 billion, and 5 years later, nearly double, 22.7 billion. So some strong growth from the company. And when we take a deeper look, we can see that consistent year on year increase to the top line, which is very good to see. And shortly, we'll look at the 10 years with the percentage as well. Now, the bottom line, how does that follow? Well, net income December 2018, just shy of 3 billion on that bottom line. December 2022, double that on that bottom line. So very strong growth on the bottom line, in line with the revenue. A more granular level look, we can see some slight inconsistencies with December 2018, a slight drop to 2019, and then it picks up and continues to increase, and then a slight drop from 21 to 22. So small inconsistencies, but overall very, very strong on that income statement. And a quick health check. Well, in terms of the balance sheet, total cash, December 2018, around 4.7 billion on the balance sheet. Latest quarterly report, around 6.9 billion. So they are holding more cash over that 5-year period. Now, in terms of their total debt, well, how does that compare numerically and directionally? Well, what we can see, total debt around 3.7 billion in December 2018, and an increase there in their latest quarterly report to 6.1 billion. So it has increased the total debt, as we can see, but so has that cash balance. And now let's take a look at that all-important dividend safety and the financial metrics that support that. So essentially, 82, it is very safe. A market cap of 237 billion, making a mega cap company. Now, in terms of some key metrics for those that believe we're heading into a recession, well, last recession, 07-09, they did in fact cut that dividend, which is a shame. Recession sales, in fact, a huge negative 56% drop, which was below the average growth in 07-09 of S&P 500 companies, which was also negative, but at a smaller rate than ASML, and the recession return was in fact in line with the S&P 500's negative 55% return. So a bit there to just digest if you believe we're heading into a recession. Now, dividend growth metrics, they have been paying those increasing dividends 13 years in a row. Latest increase, 5.8% in July 2023, so only a few months ago. 33% compounded annual year on year on that dividend, 27% over the last 10 years. Phenomenal increases. And what I always say, as a bare minimum, 4%, because 4% was the US inflation rate over the last 40 years. Anything less, you are taking a pay cut and losing purchasing power. And that applies to your dividends, salary, and other income producing assets. Now, in terms essentially of dividend yield theory, it says that the company is undervalued when the current yield sits above the 5-year average. As we can see here, 1.09 versus 0.47, one strong sign of undervaluation. However, as always, we never look at any model in isolation, and we'll draw our conclusion towards the end of the episode. Likewise, forward PE at 28.4, below the 5-year average of 31.9, another sign of undervaluation. And comparing it to the sector PE, the information technology at 20.4 with ASML at 28.4. As I did mention, it is towards the middle of that 52-week price range. However, if you've seen these videos before, you know even the stocks that are at the 52-week low, that does not signal undervaluation. Likewise, 52-week high does not signal overvaluation. Earnings versus free cash flow, we always ignore the earnings. If you're a regular viewer, you know why. Basically, companies are susceptible to manipulation by management through their accounting, so therefore the free cash flow is a lot more accurate, but I've left it up there for investors who do like to see it. What do I look for? Personally, 60% and below. Why that figure? For me, it signals that management are able to increase those dividends to double digits that we love to see as dividend growth investors. For the large part, as we can see, it's in fact been below 50%, with the last few years straddling around 30%. 2023 expected to be even lower at 20%, so I would like to see next year a very strong double-digit dividend increase. Likewise, earnings per share is something I tend to ignore. Free cash flow per share, 196 in 2013, 18 in 2022. Incredible growth, although you could note that to the last few years, but still over the period it has gone up quite dramatically, which explains why it is pulling back slightly. 14.9 expected in 2023, but I would still like it to see go even higher over the next few years, so it is important to always look at any forward guidance that we have available. Sales growth, well, 3 to 7% is what I mentioned. If we take a look, nearly every year they smash that, more than 3%. In fact, over the last few years, it's consistently been in the double digits. Numerically, 5.25 billion worth of sales in 2013, 21.2 billion in 2022. So essentially 4 times the growth of the top line in the last 10 years. Very strong. And if they continue to do that, we can expect to see some really strong share price appreciation. Shares outstanding. We love it as investors when companies do share buybacks, returning excess cash to our pockets. 433 million in 2013, 398 in 2022. Not massive buybacks over the last 10 years, so not really much to note there. ROIC, one of my 7 golden dividend metrics. It's the other 6 you can check on the pinned YouTube video. Plus 10% is what I like because it gives me faith management are able to effectively allocate that capital. So what do we see here? Consistently above 10%, and the last few years some really strong high double-digit figures. So very strong metric, and so far it's been a lot of quality that we have seen in this company. Operating margin 16% plus consistently again year on year, very strong. Likewise with their free cash flow margin. This is a very strong and healthy business so far. And this is probably one of my most favorite metrics of the company, the net debt to earnings before interest, tax, depreciation, amortization. 1.5 being the threshold for what we like to see, with this being the number of years it would take the company to pay off their debt net of cash on hand, essentially showing that the company, if they wanted to, could pay off all of their debt on the same day. That is how strong of a company it really is. Now, as always, if you have been enjoying the content, value is being provided. Smash that like button, hit that subscribe if you haven't already. Join this lovely community and hit the bell button if you want to have these videos directly dropped to your doorstep. And as always, if you want to grab a copy of the valuation model and get your own intrinsic value of companies in your portfolio, do grab a copy in the pinned description below. So let's start off with the stock ticker ASML, earnings per share at 20.11, growth rate per analyst estimates at 24, with that yield on AAA corporate bonds, giving an intrinsic value of $546. Now, when we take a look here, we can see it's showing that it's slightly overvalued by the current market based on Graham's valuation, but within that 52-week range. Then moving on to the multiples valuation model, companies in a similar sector and size. We have KLA Corporation, Lam Research Corporation, and Analog Devices. We have their stock price, earnings per share, and P multiples. We get the average P multiplied by the earnings per share of ASML to give a stock price of 414, showing that based on that model, the current price of the company in the market is overvalued. However, it is still within that 52-week range. Now, you could argue a lot of these companies have taken a hit lately, as well as the semiconductor industry, and therefore this has pushed a lot of their PEs down, hence why we are seeing this low price here. Now, the dividend discount model, one of the great things about this company is their increases in those dividends. Average growth around 33.6%. Forward looking, I've gone for around 7.25%. As always, you can justify slightly lower or slightly higher. It really depends on your justifications and the evidence. So if you do want to play around to get your own values of the DDM as well as other prices, do grab a copy of the valuation model in the pinned comments. However, based on these estimates, giving a DDM price of $829, showing some strong upside to the current trading price and well above that 52-week high that we have seen not too long ago. Now, the fourth and final model, the discounted cash flow model, where we have the free cash flows year on year with the average growth rate coming in at 38.5%. Forward looking, analysts estimating around 16 to 18%. So we have gone slightly lower to be more conservative. With our discount rate, we get the present value of future free cash flows and terminal value. Add that with the cash, subtract total debt, and we arrive at our equity value. Divide that by the shares outstanding, gives us a DCF price of $890. As we can see, some strong upside again to the current trading price and well above that 52-week high, showing signs of undervaluation in the current market. As always, smash that like button if value is being created. You're really enjoying these videos, let me know. And the intrinsic value, as always, is the average of the four models we have just run through. Now, you could argue that some of these are inappropriate, such as the Graham's valuation or the multiples valuation for the reasons as mentioned earlier. So again, if you do want to play around with these figures, do grab a copy of the model below. So based on our estimates and judgments, the intrinsic value is coming in at $670, as we can see, showing some nice upside to the current trading price, but within that 52-week range. Now, current price, it is dropping, so it was 593, now 594, not too far off. Margin of safety, typically I would say 10% for a company with a wide moat, strong financial metrics, good forward-looking data. Now, this is really one of those companies where I believe you could argue between a 10 to 20% margin of safety. So if you were looking for a 10% based on what we run through today, it is a buy. 15% around 570 would be a buy. And again, those who are looking for a really high margin of safety on this very, very high quality company, you would be looking at around $535. Now, personally, I think 15% is more than enough margin of safety of this company. And for me, I will be looking to add this at around $570 and then dollar cost average in. But it looks to be such a strong company that I would still believe that people who were to lock in a 10% margin of safety, essentially at these prices, you would be looking at a very strong company for the future. Now, Wall Street forecast the price over the next 12 months to hit around $785, again, reinstating that they also believe this to be a very undervalued company. As always, let me know your thoughts in the comments below. Are you looking to sell? Are you looking to buy ASML, or purely on the sidelines speculating? As always, smash that like button if you've enjoyed today's episode. Subscribe if you haven't already. And as always, if you want to grab a copy of the valuation model, click on the link in the pinned comment below. Have a great day and catch you on the next episode.